Welcome to everybody to the Better Investment Conference session on cryptos. Crypto bubbles are being popped everywhere, and some of the more speculative cryptos are down 80% in the last few months. My name is Ciaran Ryan. I'm the host of the Moneyweb Crypto podcast, and we're going to be talking about some of the reasons behind the drop in cryptos and are there opportunities in this. Bitcoin and Ethereum are down, but the die-hard Bitcoin supporters say we've been here before. Remember back in 2017 when Bitcoin dropped 84% from its high before it started recovering. Now, the proximate cause of this was the collapse of the Terra Luna ecosystem, which wiped out a reported $40 billion in value. For crypto skeptics, and there are plenty of them, this was an I told you so moment. What does this tell us about cryptos generally, and what can we expect from here? Well, joining me to discuss this are Brett Hope Robertson, who joins us virtually from Cape Town. He's head of investments at Revix. And Steven Sidley, who is co-author of Beyond Bitcoin. He's also a partner at Bridge Capital. And Steven is here in the studio. Welcome to both of you.
Thank you.
Cheers, thanks.
Just a little quick bio there. Brett, you were a derivatives analyst and dealer for many years, and during your time as a derivatives analyst you also helped build a derivatives hedge fund strategy, but you found yourself drifting into the crypto space, as I understand it, and you enrolled on a course at Harvard Extension School where you learned about Bitcoin and blockchain coding, and you've graduated from UCT with a master's in investment management, and you're also a level 2 CFA.
Yeah.
And Steven Sidley in the studio. He's an award-winning and multi-shortlisted author of 5 novels, 1 non-fiction book, Beyond Bitcoin, Decentralized Finance and the End of Banks. That's a very provocative title. And that you co-wrote with Simon Dingle. And we've had you before on the Moneyweb Crypto podcast. Good to have you back again. You're also a playwright and a regular contributing columnist to outlets like Daily Maverick and Business Day. You have an MSc in computer science from University of California, Los Angeles. You lived there for many years before coming back to South Africa. And you spent decades working as CTO for a lot of global listed companies, including Anglo-American. And currently you are a professor at the Joburg Business School, University of Joburg, right?
That's right. Yeah.
Good. Well, let's get into this. It's a question I'm going to direct at both of you. What have we learned from this Terra Luna collapse? I'm going to start with you, Steven, first. Everybody has understood, well, getting to understand what a stable coin is, but that we would have something which is supposed to be backed by real assets, which just disappeared completely. What do we learn from this, and what does that tell us about cryptos generally?
Okay, so there are kind of 2 questions embedded in there, Ciaran. The first one is the Terra Luna system, which was spotted by some crypto analysts early on as being architecturally unsound because in fact it was not backed by any real assets. Terra was supposed to be backed by $1, 1 Terra equals $1, but in fact Terra was backed by a token called Luna, which had no particular backing other than public perception. So some people said earlier on, this is unsound, this is going to collapse. And it was pretty much ignored, and it was ignored quite loudly by the architects of the Terra system. When it finally did crash, it crashed into, and this is the second part of the question, into a perfect storm of bad news. And the perfect storm of bad news included inflation, included regulation, included the leverage that had taken place within the crypto ecosystem. So when Terra Luna started collapsing, those people who were exposed to Terra Luna started collapsing as well, and there was a domino effect, which has now included a big project called Celsius, a big investment company called 3 Arrows Capital. So there was this perfect storm of bad news, and it brought the whole crypto market down. Before Terra Luna, it was sinking anyway, along with NASDAQ and all the other stock markets. When Terra happened, its downward trajectory accelerated. All of this means, in my view, absolutely nothing to the future value proposition that crypto represents. And that value proposition is both in terms of the good that crypto is doing around the world and also in terms of the pricing of the assets. So you are looking at one person here who is entirely unconcerned about the price of crypto. I'll remind the audience that crypto, Bitcoin particularly, its price has dropped far in excess of the current bear market 3 times in its history from 2011 onwards. I held Bitcoin when it went from 19,000 to 3,000, which is a bigger drop than this. I was unconcerned then, and I'm unconcerned now.
Right, Brett, same question to you. Just tell us what you think the Terra Luna collapse has done. And Stephen did mention Celsius, which is a decentralized finance lending platform. They suspended withdrawals. So there's something going on here, because the returns that are being offered on some of these lending platforms did seem to be unsustainable, 17% per annum. Is this the end of the good days?
No, much the same as Stephen. I don't really worry about this crash. I think it's actually something quite needed. We needed this deleveraging to happen in the system. There was far too much leverage in there already. But the kind of takeaways I've learned from this Luna UST kind of collapse, right? As you said, it's pretty historic. It's two top 10 cryptocurrencies kind of disappearing off the face of the map within a week. And I think what we can see is, one, the crypto market is still very immature. And the one thing that happens with that is these immature markets experience really high volatilities, more than traditional markets, and they have really strong correlations between assets. And that's exactly kind of what we saw with this Terra collapse, right? You saw UST and Luna obviously fall off the map. Then you saw the Luna Foundation kind of step in and have to sell their $1.5 billion worth of Bitcoin reserves to try to defend this peg, right? And when you have a big sale like that in an immature market, as kicked in also with this contagion around the peg, contagion around Anchor disappearing, bad macro outlook, you kind of get this correlation falling to one, right? And the whole market pulls back. But what we kind of learned from this is, you got to understand that this market is still very immature. And you've got to be mindful of this when you're going into these kind of panic situations. There is a couple of positives I did see from this. Anchor itself is meant to be this decentralized bank, right? And it actually kind of showed that it could probably handle a bank run a little bit better than we possibly thought, and actually a bit better than a bank. So if you think about it, a bank holds about 10% of its reserves, its deposits as reserves, right? So that kind of means if 10% of depositors pull their cash, the bank kind of closes its door. Anchor handled the 55% pull on deposits within 4 days and still kind of held its peg at around 0.91-ish. That's pretty impressive, eh? So there's some kind of pros to this DeFi that could actually probably solve a kind of bank run issue. But I think the main thing we kind of seen from this is that, diversification always wins. And the simple fact that you don't want to have all your eggs in one basket. There's that saying by Mark Twain, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. I think we've seen, some terrible stories of some companies, some funds, some exchanges that were really severely hurt by this. And I think, they thought that UST on Anchor was a no-brainer and a risk-free trade to get a lot of yield. And it just wasn't so, and they got burnt. So I think the main reason for diversification kind of plays into this kind of market at the moment. It's in these times of panic, diversification is worth its weight in gold, and spreading your risk across multiple assets, whether it be through a bundle or you do it yourself, is something so important, so you don't lose everything in one hit or lose a business in one hit like we're seeing 3 Arrows Capital kind of doing. So yeah, there's a couple of takeaways from there, but I do think what we have learned is that the crypto market is one of the most adaptive and progressive sectors, and this kind of deleveraging we're seeing is just going to make it come back stronger, I think.
So you're not concerned about the drop in price that we've seen over the last few months? You're expecting a rebound from this. And talk about that for a minute. Could we see it go lower? Because back in 2018, the price dropped to about $3,300.
Yeah, I mean, look, it can definitely go low. There's a lot of contagion. There's a lot of, as I said, deleveraging. And obviously the macro backlook isn't the best, right? There's no reason saying it can't go low, but there's a lot of long-term kind of deep value metrics that are starting to scream a little bit, right? We've seen the 200 weekly moving average for Bitcoin. We've seen Bitcoin kind of drop below that for the first time, or the second time ever in its history. And the last time was March 2020 in the liquidity crisis, right? We've seen Bitcoin drop below its production cost, which is the first time since March 2020 as well. And the basic idea there is that Bitcoin shouldn't really trade below the cost of the energy used to produce it. That's a very much a value metric. We've also seen, Bitcoin's price is trading below its realized price, for example, which is basically the whack of the whole market, the average cost that everyone paid for Bitcoin. That kind of tells you that the whole market, on average, is underwater. These are deep value signs, and you're also seeing the futures market in Bitcoin kind of reset. It's the lowest it's been since December 2020, and that was just before Bitcoin kind of went on its run from 20 to 65K. So yeah, there's a deep reset, and who's not saying it can't go lower? There's some structural bases at around 12,000. If it gets there, it gets there. But these value metrics are starting to scream, start buying in. A little bit of DCAing, I think, here would be a reasonable assumption. I mean, if you look at Bitcoin itself, something that survived 8 separate 50% corrections with no bailout, and kind of exits it and goes on to all-time highs, is something seriously you need to look at as an investment opportunity.
Steven, same question to you. You said that you're not worried about this, and Brett brought up some of the metrics that he's looking at. The cost of Bitcoin production, it's, if I'm not mistaken, it's about 24,000 or 24,500. So we're now today trading at about $20,000. It did touch a low recently of $17,700, went back up again. The other thing which hasn't happened much in history is the fact that it broke the 200-week moving average and then has sort of come back up to that or close to it. And it's only got a decade of history, but that history does tell us something, that Bitcoin doesn't very easily break these patterns. What do you think of that?
Okay, so I would agree that there are a bunch of investment metrics, which Brett points to, which is screaming undervalued. But we all know that anybody who's been foolish enough to try and apply traditional technical analysis to the Bitcoin price over the past 10 years has ended up at some stage with egg on their faces. So if one is to believe in Bitcoin, one is believing in the long-term value proposition. Whether it will go down to 12,000 or 18,000 or suddenly take a rally from here is just about unknown to anybody. What one needs to look at is whether there is fundamental value in the technology and the magic that it shows to the concept of self-owned money, secure self-owned money. And that is a long-term view. And so from my perspective, the price of Bitcoin, number one, is irrelevant. Bitcoin and what its blockchain does has not changed at all during these price crashes and rallies. And if you believe that there is an underlying value in the blockchain and there's particular cryptocurrencies, there are others, of course, but Bitcoin is the original gangster, then one just holds on and waits for it to go up to the value which will, in my mind, certainly increase in the long term, and not to panic and get out every time the price moves. What Brett alluded to, I strongly agree with. Two things have happened within the cryptoverse over the past 4 or 5 weeks. There have been a couple of mutants in the gene pool, and one of those mutants was Terra Luna, and that mutant finally is getting snuffed out by evolution. But what it does, it's infected a whole bunch of other creatures that were exposed to it. The second one, probably as unfortunately, or there were a great deal of speculators in the market who leveraged up to a point that was unsustainable, and they got liquidated on the way down. So the mutants will continue to be flushed out by evolution. The speculators will continue to be whipsawed by price movements. But meanwhile, the Bitcoin blockchain runs and does exactly the same thing that it was doing when it was $68,000.
Okay. Brett, let me ask you this question. Are we going to start to see the beginnings of a flushing out of non-viable projects in the crypto space? I mean, there are 15,000 different cryptos. Most of these are just not going to survive. Is this the start of that process of flushing them out?
Yeah, so I think, look, in any market, not just crypto, especially when you go through a big downturn like this, right? As Warren Buffett would call it, as the tide goes out, you kind of discover you're swimming naked. And I think you're seeing this kind of take place right now, right? Not only alternative coins or altcoins are getting hurt badly. We've been seeing, really poorly risk managed lenders and hedge funds also coming under huge pressure. As Stephen alluded to, there was a lot of leverage in this market where you had Three Arrows Capital, one of the biggest hedge funds, getting put under huge liquidity pressure because basically they got a bit greedy. They got caught on Luna. I think they had $560 million locked in Luna that's currently at a value of $600. I mean, that's a big drawdown. And they had borrowed against a lot of their assets that they had. They either went leverage long or deposited into Anchor to earn a yield. And when you are leverage long and things like the news of Celsius comes out, or there's a pressure on the state ETH versus ETH peg, the market starts to panic, drives lower, and you get margin called. And if your assets are locked up, you can't actually get the liquidity to get out of those margin calls, and you actually get liquidated. So we've seen this whole deleveraging. I think there's going to be a lot of coins that go to zero, a lot of underdeveloped coins that go to zero. Much like the internet bubble in the time, I think 99% probably go to zero. But you're going to be left with the OGs and the strong bases and the strong communities and the strong kind of network effects that will last on. But as we said, when there's huge financial pressure, there's a pull on credit. Credit leaves the system. Overall money in the system leaves. So now think about basic math says we have less credit and less money in the system, but the same amount of coin price goes down. And that's kind of what we're seeing here. But these retests are needed. I mean, we need to flush out the bad actors. We need to flush out the systems that aren't working so that the stronger systems can come back.
Stephen, the stable coins were the fastest growing subset within the crypto space. And they're supposed to be backed by real assets such as the US dollar. So people may be a little bit confused that you have something like Terra Luna, which was an algorithmic coin. And what they were trying to do, evidently, was to not have a fully backed stable asset, but to do it programmatically. And this, of course, resulted in their unwinding. Now, how is this collapse going to affect the stablecoin environment? Because I think a lot of people are confused and they're going to associate one with the other. For example, Tether, they're audited. We know that they are backed by real assets. It's not that they're backed by dollars, but they're dollars and dollar equivalents. What does that tell us about this space, and what changes can we expect going forward?
Okay, I just wanted to pause and perhaps for some of the people who are listening, explain why there is such a thing as a stablecoin in the first place. The stablecoins' prices are not supposed to move. They're supposed to be tied to a hard currency. Most of them are tied to the dollar. Why do these things exist in the first place? The reason why stablecoins were invented, and they were invented in 2017 by Rune Christensen in a project called MakerDAO, was that when you wanted to trade in and out of crypto, you kept having to go back to your bank. So you went to the crypto world and you bought Bitcoin and you sold Ether and you did a bunch of stuff, but you kept having to go back to the traditional fiat system, which was onerous and it was heavy friction and there were bank fees you had to charge. So what Rune Christensen did in MakerDAO is he invented a thing called DAI, which is the name of his stable coins, so that you could remain in the crypto world when you were on pause. You didn't have to go back to your bank. You could sell your Bitcoin and put it in DAI and it was still there in the crypto world, and you could instantaneously, a couple of days later, decide to buy or sell something else without going back to your bank. That was the reason for the stable coin. It turned out that there was an astonishing demand for the stable coin. So when DAI was launched in 2017, money poured into this thing so people could have this stable crypto assets as a home base and a safe base to leave their stuff when they weren't trading. That stable coin got copied, or the concept of a stable coin got, I don't want to say copied, it got rebirthed in a number of different guises. And there were two guises which sort of arose. One was, as you mentioned, the collateralized backed stable coin, where there was $1 sitting in a bank account, a real bank, a traditional bank, for every one stable coin, and USDC is an example of that. Tether is not quite the same. Tether's assets are backed not by 100% cash, but by short-term commercial paper and other safe assets. And then there was the other guise of stablecoins, so those stablecoins that were ingeniously constructed so that it would keep its peg to the dollar via basically arbitrage, algorithmic arbitrage. And those have not fared as well, although DAI, which is partially collateralized, and they're hybrid models, and DAI is one of the hybrid models. The problem in stable coins, and by the way, stable coins are an enormous part of this market now. I think that today Tether was 67 billion was floating around, and I think USDC, there's over 80 billion floating around today. There's a lot of money in stable coins. There's systemic risk to financial systems. The reason why stable coins will change or will come under pressure will not be because of their performance, it will be because of regulation. The worldwide regulation, and the US, everybody looks to the US for regulation no matter what anybody else does, is taking the position that stable coins need to be backed one-to-one to a real dollar sitting in a bank. Now, the maximalists and zealots who live in the crypto world, of which I am partially one of them, are screaming bloody murder about this because the whole point of crypto was to be non-regulated. But we live in the real world, and those sort of regulations, from my perspective, are rational. So I think what you will see in the future is stablecoins will survive, private stablecoins, blockchain stablecoins, and they will survive with the regulatory diktat that they have to be backed one-to-one to the dollar.
Okay, just to mention that please send in your questions to clients@moneyweb.coza. Now we have got a few coming in. We'll get to them in a minute, but I just wanted to follow that up with Brett about this stablecoin issue. Do stablecoins have a future, Brett? Given what we've seen, I mean, they really have a utility because you can now have a dollar or a rand that is virtually backed, not virtually backed, is backed by real currency, and can be transferred anywhere in the world at very low cost. And that's the thing. I think what Steven was talking about there is what people wanted. They didn't want to be exiting the crypto space and paying all the bank charges that they would have to pay when they converted back to fiat. So do they have a future?
Yeah, I mean, of course they do. I think, as Steven said, they're also the biggest probably systemic risk to crypto at the moment. They're massive. But yeah, they took huge form because, as Steven was saying, people wanted a place to park their cash when they were getting in and out of Bitcoin or crypto, whatever it was, right? Instead of going back to the bank system itself. So that was the main thing for it. And it was pegged to a dollar, which is, a fiat system that was very relatable to a lot of people. So they didn't have to go, if they were trading in a altcoin, for example, if they want to go park it back in Bitcoin, that was kind of a hard thing to denominate your wealth in at the time. People were still struggling with the whole maxi Bitcoin, let's denominate our wealth in Bitcoin, rather than actually a dollar. So that kind of helped it a lot. There's going to be a massive space for this. I think it'll always be there because human beings will always associate kind of, value and a metric to something that can count in a dollar form. So that's why I think it'll be there. And as we've seen now with this algo crash, anything with algo stablecoin attached to it is pretty much gone the way of the clog and disappeared. But people are kind of running to safety, and as we said, USDC is kind of the most safe stablecoin at the time, fully backed by reserves and obviously in cash and short-dated US government obligations, etc. And they get audited and they show that they have more cash than they have circulation, so they're over-collateralized. And that's a huge thing, and I think that's something that we need to see from this whole crash, is that we need transparency in this crypto market. I mean, the last few months have shown us anything. It's kind of that we need to assure customers that their assets are safe and accounted for. I mean, that has to be the base market. That has to be the base market for these people. We've seen a lot of regulation coming offshore, but it's quite focused on AML and KYC regulation. And I think they're kind of missing a big trick here, is that you should be kind of focusing more on accounting for customers' assets. Instead of this anti-money laundering, maybe the crux of the matter should be, are companies holding the assets that they say they're holding? That's the most important for the end customer, right? So that's got to be the best case.
I'm going to stay with you, Brett. By the way, I think I gave the wrong email address there. I'm going to correct that. It's events@moneyweb.coza if you want to send any questions through. Events@moneyweb.coza. It's a question from Joseph coming in on this very topic, Brett. He's asking, for stable coins, are these algorithm-based stable coins possibly the future of the crypto space? What do you think? Do they have a future?
It's a tough one. Look, I think there might be a space for them, but with this latest attack, they've got a bit of mud on their face at the moment, and I think it's going to take a while for them to come back stronger. If you can think about it, the algo stablecoin was held together by an arbitrage, basically, right? And that works when the peg sways from 1 to 1.1 and 1 to 0.9. That kind of works. You can picture it as take a ball and put it upside down. The ball on the top kind of works around here, right? It works in this range, but as soon as it falls off the edge, it's gone. So these algos and arbitrages, as soon as it goes past 0.9 or 1.1, it's not worth their risk to back that it's coming back to its peg. And that kind of is what we saw with this lunar terror cycle, is that people just wanted out, they didn't back that the peg was coming back, and you end up printing a whole bunch of lunar, it becomes a hyperinflationary asset, and the peg kind of never recovers. So if they can fix that part, maybe that, it's partly algorithmic and 70 or 80% backed by USDC or something like that, then you can kind of see a place for it. But at the moment, I think a fully algorithmic stablecoin is a long way away from being something that people will trust again.
Stephen, this is a question that's also from Joseph. What would you recommend, investing outright in ownership of cryptos or transacting, in other words, trading? And what would be the pros and cons of both in the short and long term? You want to pick that one up?
I would, with all the caveats that I'm not trying to give financial advice over here, Joseph. Thanks for that question. I have my own preference in this regard. My own preference in this regard is buy and hold. It's the Warren Buffett view of investing in the crypto world. The only two safe assets that I would recommend, literally the only two safe assets that I would recommend are Bitcoin and Ether. They have the most mature ecosystems. They have the most interesting things going on. They're the most hardened. They're the most unlikely ever to be hacked. And by the way, neither of them have ever been hacked. There are other interesting ones over there. This is terms of straight investment. There's Cardano and Solana and Avalanche and Phantom. They have their own risk profiles, which are too high for me. So in terms of an investment strategy, just like Warren Buffett would stick to the big companies that have certain ratios, I stick to Bitcoin and Ether. In terms of the second part of your question, should one trade? And whether that is trading in non-cryptocurrencies, in other words, trading in tokens that belong to big DeFi initiatives, or using those DeFi initiatives to try and get yield. The space is very noisy right now. There are a lot of sharks in the water, as we know. Those are grifters and scammers, which one has to look out for. And in addition to that, the people who are really good at trading, the 150 PhDs sitting at Goldman Sachs in America who are looking to get an edge in the trading, probably are going to do a better job at finding edges than an individual would. So for me, I would stay away from trading. That being said, I do have friends who go in there. They call degens in the industry. They do all sorts of training and swapping in and out of very risky assets and do very well for themselves. It would not cause me to sleep well at night.
Okay, Stephen, staying with you, a question from Andre. He says, I'm a novice at crypto. Why should I invest in something that is in the ether? And I don't think he's talking about the crypto ether. It has nothing other than belief that drives its value.
The answer is not whether, Andre, I'm sorry, this is a standard answer which I give to this question, is basically what backs Bitcoin, and people say nothing backs Bitcoin. The question isn't what backs Bitcoin, the question is what backs fiat currency. There is nothing that backs fiat currency. There used to be gold when it was tied to gold, but if you live in Argentina, where you have seen your wealth drop by 40% because of mismanagement by the government, or Turkey, or Venezuela, or Zimbabwe, or a number of other countries, you'll know that fiat is as much backed by something as Bitcoin is backed by something. Bitcoin has numerous advantages over fiat currency, and I'm going to give you the most obvious one. It ticks all the boxes of non-counterfeitability and durability and divisibility and all those other nice things about money. But the most important thing that determines the value of an asset is scarcity. The reason why gold was considered an asset of value is that it was difficult to mine and difficult to find. It separated from money in 1971 in the United States. It's not tied to money anymore. Governments will tell you that they will not debase your money by printing it. It turns out that every single nation state, we did this research for the book, every single nation state that has gone bankrupt in the past 3,000 years has gone bankrupt because the government printed money. They salted the gold coins in the Roman Empire so that they could defend they could invade the next country. The hyperinflations of Austria was the same issue, and it is the same issue now in America, where 70% of dollars that are now in existence were printed in the last 2 years. There is nothing backing fiat currency. There is only public perception, and worse, you don't have a say in how much of that perception, how much of that value is going to be debased by your government. In the case of Bitcoin, there is a finite amount of Bitcoin. Nobody can print more Bitcoin. It is not under the control of a government who may make ill-informed decisions like that. So the answer to your question is there is more backing Bitcoin than there is fiat currency.
Brett, do you want to add something to that?
I think he's covered it all, really. Those are all kind of the checklists that we were saying. I mean, it's literally the power of having control of your own hard-earned money, right? And as you were saying, we've seen it now. 70% of all money in the US has been printed in the last 2 years. I mean, that's crazy. You think of someone who's worked their whole life and now all of a sudden their money is just getting printed away. It's kind of the same thing, why we see quite a big kind of adoption so in South Africa is our country is kind of got the perfect storm of looking for an alternative money. I mean, we've got kind of sovereign risks, we've got a weak currency, we've got a high number of unbanked people, we've got a bit of high inflation as well. So all of these things, Bitcoin kind of steps in and kind of ticks all the boxes of fixing.
Right. I mean, I think we did this exercise at Moneyweb. We looked at the value of the rand since it came into being in, I think it was 1961, and it had lost more than 90% of its value since then. In other words, if you were earning 200 Rand a month back then, you were probably in a lot better position than you are today. I want to talk about regulation here because we know that regulation is coming, Stephen. Now, Bitcoin was born as a kind of a revolutionary initiative. It really was a rebellion against this kind of recklessness of financial management that we've seen worldwide by central banks and the overprinting of money and the debasement of fiat currency. When you talk to the people who are involved in this business, they do welcome regulation because it provides some sort of legal certainty to institutions, to pension funds, and so on. You say, okay, well, now we're dealing with a financial services provider, however they will be licensed, and therefore it's probably safe to put some of our money in there, and we'll treat it as an alternative investment, and there will be caps on that, how much they can put in there. But this does seem to be a deviation from the original founding philosophy of Bitcoin, does it not?
It does, and you're correct. The original founders, I want to say inventors of the blockchain. And by the way, when Satoshi wrote his 9-page white paper, and I urge everybody to go read it, it's not that complicated, and it's quite epiphanal. The original founders of the crypto revolution were not specifically zealots to that extent. What they wanted to do, first of all, was a hobby at the time. They were trying to find a way to solve a whole bunch of problems that had bedeviled researchers since the invention of the internet, which is how to make internet money. So part of it was hobbyists, part of it was mathematicians, cryptographers who were having fun playing with the stuff. And part of it became, how do you build a system that is inflation-proof? There was some expectation among some of those people, Hal Finney and some of the others, that this may become worth something one day. But none of them had any idea that it would have any value until one of the programmer's fathers offered 2 pizzas for 10,000 Bitcoin. It's, by the way, celebrated as Pizza Day every year in the crypto community. And from that beginning, a whole bunch of zealots and evangelists sort of saw the light. They became obsessed, had got a religious fervor in their eyes. We are going to build a parallel system of money which is going to be outside of the control of anybody. That vision still exists among many, and that vision, from my perspective, is unachievable because we live in a world in which there is a parallel system run by nation states, and those nation states are not going away. And so one has to find a regulatory middle ground which allows people to continue innovating in this space, but allows the world of crypto to meet in the center, and that's where the regulation happens. The regulation happens at the on-ramp, which is your bank, to put money into the crypto world and to sell crypto and to get it back into the real place so you can walk into a store and buy something. There is some gray areas, like what is happening in El Salvador, where you can actually go and buy a loaf of bread from the El Salvadoran equivalent of a spaza shop using your cell phone, and they're doing it. But it is my expectation that it is childish to believe that the entire crypto space will take over the entire fiat space. Because if that is going to be the case, then you have to look at nation states giving up control. And nation states are not going to give up control without a fight. Sorry, just to end this point over here, very important. There are 3 things that a nation state absolutely has to have to control its economy. It's got to collect taxes. Yeah. It's got to make sure that money is not given to bad guys, terrorists or some other country that wants to hurt you. And number 3, it has to see the movement of money through the economy so they can pull the levers of interest rates and capital injection and liquidity in order to keep prices and employment stable. That is the job of a central bank. A nation state cannot do that if the money is hidden in a private system. That is why they are so obsessed about control, and for good reason.
All right, just a reminder, the email address, if you want to send in questions, is events@moneyweb.coza. events@moneyweb.coza, and we have got quite a few questions coming in. This one is quite a follow-up here. It's got to do with central bank digital currencies, and it's a question from Anne. She's asking how these government-issued virtual coins would impact the crypto sphere.
The central bank digital currencies are not stable coins, and they are sort of an insult to what a blockchain is supposed to do. First of all, they are permissioned. The bank gives the permission to release these coins out, which are equivalent to the digital equivalent to the dollar. Banks already have digital currencies. They move digital currencies around all the time. You know, they don't actually move cash around all the time. They have things that change entries and ledgers. Their interest in the blockchain is it makes things easy to track, but what it does not do is make it permissionless. It is not decentralized. It is centralized in the government. So they're taking the parts of the blockchain which are technologically powerful and they make things easy to track, they get things to settle fast, but it is a very, very long way to the permissionless blockchain that was invented by the powers of this technology. There will be central currencies, digital central currencies. The problem with them is they range from China's digital one. China's digital is not necessarily a digital currency. Yes, it is, but what it really is a way to surveil your citizens. That's why they want it. They can tell what their citizens spend, and they can say, you did a bad thing, you posted something we don't like, you can't travel on the public transport anymore. All the way to El Salvador, who says, come and have fun, or the Central African Republic, who says, come and have fun. Somewhere in the middle there's going to be some central currencies which act exactly like cash, but one has to remember they will never be permissionless, and they can always be retracted by the government.
Okay, there's a question from Matt here, Steve, while we try to sort out Brett's sound. What's the best way to start or to buy Bitcoin and Ether in South Africa?
So there are a number of centralized exchanges, they're called. The 2 biggest are luno.coza, Luno.coza, and valor.coza. There are a few other ones. And actually, Brett is probably better suited to answer this than me. Is to open
Revix as well.
And Revix as well, of course. To open an account at one of those crypto exchanges, South African crypto exchanges, the ones that are legitimate and the ones that we've talked about are legitimate, is exactly the same as opening an account at a stock exchange. You've got to show your ID, you've got to do the whole KYC thing is you transfer money in your bank in, and then you will see a choice of cryptocurrencies that you can buy, and then finally after being terrified, you press the button that says, please buy me 1,000 rands worth of Bitcoin, and you're in. It's very, very simple to do with the centralized exchanges. If you do it in a non-centralized way or a decentralized way, and there are ways to do that, it's a more terrifying experience. It's more flexible for many reasons. But my suggestion to the questioner is go to one of those exchanges, Revix or Luna or Vela, and there are a couple of others. Try to choose one that you read a lot about in the press, because it means that they have a lot of liquidity. Open an account, buy 500 rands worth of Bitcoin, and you will fall down that rabbit hole and have a wonderful time doing it.
That's right. People ask me that. I say buy Bitcoin and don't pay too much attention to price, because it'll just get you interested in the space, and you will start studying more about it. There's a bit of contradictory information that's coming out about Bitcoin. The price tells us that the enthusiasm is waning. That's the one indicator. But there are surveys suggesting that people who are buying for the long term. There was a study came out a little bit earlier this year called Bitcoin Knowledge and Perception by Block Inc. And what is interesting about that survey is that South Africa is way ahead of other countries when it comes to the optimism for crypto. Okay, that survey probably needs to be redone in light of what's happened in the last few months. But why do you think that is? I mean, people are, the rate of adoption of Bitcoin is rising, and Bitcoin is the granddaddy of them all, as you mentioned earlier, and when it rises, everything else rises. So what does that tell us about crypto generally?
Well, if you want me to answer the question about why there seems to be more optimism in South Africa than anywhere else, it tells a sort of a sad and unfortunate story. Is the places where there's the most optimism for crypto are the places that have the least faith in their governments, which is why you will find an enormous amount of crypto trading in places like Turkey and Venezuela and Colombia, and those places that are being hyperinflated, or at least partially hyperinflated. I think there is a lack of confidence among some in the future of the country, or at least the future of the rand, and that's why there's a lot of optimism here. I don't want to call it optimism. There's a lot of interest in being able to trade outside of the regulations, or outside of the eyes of the government. As a general answer to your question is that there are only 150 million people in the world, somewhere between 150 million and 200 million if you include, depending on whose studies you follow, who dabble in Bitcoin. It's very small compared to the 7 or 8 billion people that are out there. There are 50 million Americans, which is quite large. 23% of millennials have dabbled in the crypto world, NFTs and cryptocurrencies. This thing is growing very, very fast. If there is a lack of enthusiasm, or if you're pointing to a study that shows a drop-off in enthusiasm, it is only because of the volatility we're now seeing. And our expectation is, in the studies I've seen, is that the growth in interest and the growth activity in the cryptoverse will grow exponentially over the next 5 years.
A question here from Anne. She says, both your speakers quote Warren Buffett, but hasn't he shunned crypto? You seem to apply his learnings from equities to crypto, which may be direct advice. Please comment and clarify. I think Warren Buffett's partner, Charlie Munger.
Charlie Munger, yes.
I think he did clarify that by saying he didn't really understand much about crypto. What's your answer to that?
Yeah, Charlie Munger and Warren Buffett are wrong. That's my quite simple answer. I'm applying the Warren Buffett methodology of only investing in solid growing assets. So obviously, there are no cash flows in Bitcoin, and he's quite strong about investing in cash flows. But they're wrong about cryptos. They have admitted they don't fully understand that space. It's a little bit disingenuous, because Warren Buffett has now invested in a company in Argentina who is in the crypto space, so he is dipping his toe into that water. I will give some leash here by saying that the world of crypto is fairly complex, very new, and very sudden. And spectacularly sudden. The first modern bank was the Medicis in the 1100s. There's been 1,200 years to build a financial system. This world has been around for 13 years. It's just in the blink of an eye. And I don't have a particular objection to somebody saying, this stuff is never going to work. It's a fair reaction from somebody from the traditional world to say that. It's only if you look into this more deeply do you see some of the sparkles and diamonds that are hiding in the blockchain. And Charlie Munger and Warren Buffett are just simply not going to do that.
All right, Brett, are you back? No, I don't think so. Okay.
Hello? Hello? Hello?
Yep,
Hello?
he's back.
Hello?
You're back,
There we
Brett.
go.
Okay. Well, welcome back. All right, Brett, I want to, because I think did you mention Warren Buffett? Warren Buffett, you want to talk about that? Transposing his ideas from equities to crypto. What's the story there?
Yeah, look, I think I did hear that. So I think there's definitely lessons you can take from Warren Buffett's way of investing, right? He's a long-term investor. And that's with regards to, anything, whether it be stocks, bonds, whatever it is. And yes, he's not a big fan of crypto because there's no cash flow or value metric that he can attach to it. But this is also a guy who missed the internet bubble as well, and joined it a bit late. So he's not very good at understanding new tech, and he's very good at understanding value. That's not to say he's not great at what he does, but he has missed out on a couple of key trends. And as Steven was saying, I mean, this is a very young class, right? Investment asset class. And yes, maybe it doesn't work, but the way it's growing, I mean, we've seen, in 2021, over 300 million people were using crypto worldwide, I think, roughly. I mean, its growth rate's around like 150% a year. If you kind of extrapolate this kind of out, you're looking at like 1 billion users in 2024. I mean, that's around the corner. So it's not far away. And I have this weird and kind of idea that, much like the effect that baby boomers had on the stocks, powering a 20-year bull market in the 1980s and the 1990s when Warren Buffett made all his money, I think millennials favor digital investments over stocks, right? And therefore, it could echo the same kind of dynamic that the baby boomers did on the stock market. I mean, millennial generation, their earning potential kind of caps out in 2038. That's a lot more future earnings coming into a market where I think people would buy, Bitcoin over Costco, for example. And I think just owning a part of this market, whether it be through owning Bitcoin itself or owning a top 10 bundle or something that gives you exposure to the whole market, is something that's definitely prominent if you believe that a millennial generation would prefer to own a digital asset over a stock, which I can't see why that wouldn't be the case.
I just wanted to add to what Brett said about Warren Buffett. Warren Buffett, obviously, I'm never going to have a conversation with Warren Buffett, but if I were to have a conversation with Warren Buffett, there would be an obvious question to ask. This has been the fastest and largest movement of human wealth from one asset class to another in history. It has been the best performing asset in the world by orders of magnitude over the last 11 years. Warren, how could you have missed this?
Okay, Brett,
I'd say
here's a question on that topic, and this is from Maratori. He's asking, will Bitcoin and Ethereum recover in the future?
Yeah, look, I think it's not a question of if, it's a question of when, right? We go through these cycles all the time. I mean, this isn't even the worst that we've seen Bitcoin go through. And I always kind of revert back to a simple kind of study I looked at, right? And that was, I looked at Bitcoin throughout its whole life. So from 2010 to now. And if you had bought Bitcoin on any single day in its existence, right? Say market top, market bottom, bear market, bull market, increasing interest rates, cutting interest rates, whatever you have around the world. If you had bought it on its single worst day, so say you bought the 2017 market top and you held it for a 5-year period, history has showed that the worst return you would get holding Bitcoin for 5 years was 27% a year, year on year for 5 years. That probably outperforms 99.99% of fund managers around the world. And that's the minimum. On average, it's been about 150% per year for 5 years. I mean, that's kind of the power of this asset class and how quickly it's being adopted. So do I think it's going to come back? I mean, 100%, basically. I mean, how many times have we heard crypto is dead echoed across news platforms all the time? and it seems to come back every time stronger. I think this is a natural cycle. Yes, there's the argument that Bitcoin hasn't gone through a economic bear market that we're seeing now with regards to the normal world. But I don't see how this asset doesn't come through the same it's done for the last 4 or 5 cycles.
Okay, we are running out of time. I want a couple of quick-fire questions here, and this is a fairly meaty one. Cryptocurrencies, Stephen, are the public face of crypto. But the important stuff is below the surface: Web3, digital property rights, fractional ownership of art or property or whatever it is. You've got the metaverse, you've got GameFi, you've got DAOs, which are decentralized autonomous organizations, all operating off the blockchain. And in some ways, they're more interesting than cryptocurrencies. Which of these offer the most interesting use cases for blockchain, in your opinion?
Yeah, there's a bunch of threads, or a bunch of, let's say, evolution of new creatures that came out of the blockchain. The one that we read about daily is cryptocurrencies. It's the one that people know best. And only because it's sexy. The prices go up and down. You hear fortunes made and fortunes lost. But just let me talk very briefly about the other threads. One of them is NFTs, which you've heard about, and most people think of NFTs about paying large amounts of money for questionable pieces of art. It's not. It's a new way of defining ownership, which fundamentally changes the way that things can be owned, seeded, sold, shared. It is transformative. It hasn't happened in the history of economics before that the ownership of something can be as elastic. I'll give you an example. Your title deed is a document of possession. The registration to your car is a document of possession. Your receipt from the internet connection for your PC is a document of possession. Those documents of possession are formatted in very ossified and inflexible ways. An NFT, which is a document of ownership, it's a receipt, is infinitely elastic, and it completely changes the groundwork of what it means to own somebody. And what is something, and what has come out of that is the metaverse, is Web3. For those of you who don't know about Web3, Web 1 is when we could read stuff off our website. Web 2 is where we could write stuff to the website, like cat videos and, the picture of our flat that we wanted to put on Airbnb. And Web 3 is where you can read, write, and own on the internet. There is decentralized autonomous organizations, which is a huge subject, but it takes over where corporations and partnership and limited liability companies come from. So there are a whole bunch of very deep silos that have sprung from the blockchain, of which cryptocurrency is only one, and an important one, and a sexy one, and fun to watch if you're not losing money. But all these other ones will be just as important in the future.
All right, Brett, do you want to take that up? Which of these themes are the ones that we should really be watching? I've mentioned Web3. We've got digital property rights and so on. Which ones are you looking at?
Yeah, so obviously at Revix, we enjoy the idea of sectors over individual cryptocurrencies. And we built obviously bundles to kind of track performance of these sectors. And I think the way to look for investments in sectors is kind of to look at what problem are these sectors solving, and do these problems that they're solving create value, right? And from that kind of outlook, we see DeFi, Web3, and smart contracts pretty much as the sectors that kind of solve the most issues and create the most value going forward, right? We have DeFi, which helps out with attacking the unbanked and helps them. There's over 2 billion people unbanked. Helps remittance, which is supposedly a $1 trillion industry that's it costs people to send back money into Africa between 15 to 25%. It's like a scary amount. Then, as you were saying earlier, with tokenization or part ownership, you can kind of see millennials as the kind of ninja generation that have, low income, high expenses, and they couldn't really afford these big ticket assets like real estate to buy as an investment. Tokenization really does solve that, to let you own a part of something. And then obviously they're taking on the lending and borrowing, basically the bank, where these DeFi protocols supposedly can streamline and give more yield to the end consumer than the bank taking its clip. And as you also mentioned, Web3 is, for me, just an area that's attacking, a multi-trillion-dollar addressable market. You got things like Arweave trying to take on decentralized web storage, right? So they're trying to take on Amazon Web Services. You've got Helium, which is taking on telecommunications. These are massive addressable markets. And as Stephen was saying, Web 2 very much focused on, the kind of the traditional, the traditional, the kind of 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 the tradi the seamless transfer of information, but that information was stored in centralized servers with your Microsofts, your Amazons, your Googles, etc. And ultimately, the value of that web kind of accrued to the corporation and not the end user, right? Whereas Web3 kind of steps in here and says, well, centralized services will be created on a decentralized network, transfer the same value, and ultimately the value will then accrue to the actual user and the token holder of the protocol rather than the corporation itself. And then you kind of have smart contracts, as obviously the other two sectors can't function without it. It's kind of the picks and shovels play on Web3 and DeFi.
All right, a very quick answer, please, Stephen, on this one. A question from David. Blockchain technology is wonderful, but does that equate to enthusiasm for funny money tokens built on top of the blockchain?
The short answer is the enthusiasm for funny money tokens is an unfortunate but probably unavoidable consequence of scamsters and grifters.
Okay. Brett, a quick one from you. Why would an institution go to invest in cryptocurrency?
Why would sorry, you broke up there.
Why would an institution invest in cryptocurrency?
Well, you've seen a lot of institutions kind of look at this now, putting on Bitcoin onto a balance sheet, right? They're saying that what's happening to dollars, for example, what's happening to their fiat currency losing value for a corporation, this is a very good hedge against the devaluation of your currency.
Okay. And Brett, to stay with you, how does the NFT and DAO case impact Bitcoin as a long-term investment?
How does the NFT and DAO space impact Bitcoin as a long-term investment? Look, the NFT space has attracted a lot of hype. I agree with Steven that the fundamentals behind it is amazing, and it's something that's going to transform ownership rights. But with that, obviously, you get a lot of hype coming around. I would say probably 99% of people do think that NFT is basically buying an average piece of art for an exorbitant amount. So with that, you obviously get your scamsters and everything coming around. But I think once that ultimately filters out, and we'll probably see that through this deleveraging now, with everyone pulling back, people will understand what an NFT actually means, and that will only help the case for Bitcoin, because it'll help the case for cryptocurrencies in general, and it'll help adoption grow.
Okay, we're going to leave it there. I want to thank you both, Brett Hope Robertson from Cape Town, Steven Sidley here in Johannesburg with me in the studio. And I think that was very informative. I think what we learned was crypto is not a passing fad. I think it's going to be around for a while. We've seen this before, and we're probably going to see it again, maybe to a lesser extent, these dips and these fantastic rises that we've had. But on the back of that, of course, there's some amazing new technologies which we should keep an eye on, which is NFTs and Web3 and so on. So great discussion. Thank you both.